In every era, some companies flourish while others falter. To the casual observer, they may all seem promising: strong sales, rising stock prices, optimistic headlines. But Benjamin Graham taught us a crucial truth: appearances can deceive. Some companies, though seemingly solid, harbor hidden weaknesses that can destroy an investor's capital. And it is these hidden flaws, often invisible to the untrained eye, that Graham dedicated his life to uncovering. The markets of Graham's time were brutal and unforgiving. The 1920s roared with speculative mania, as ordinary citizens, institutional investors, and professional traders alike chased ever-rising stock prices. Companies were valued not for what they truly earned or owned, but for what the market hoped they might achieve tomorrow. It was a world in which the weak could appear strong, and the strong were sometimes ignored. Then came the crash of 1929 and the Great Depression. Companies that had seemed unshakable were suddenly exposed as fragile. Investors who had relied on hype and momentum lost everything, while those who heeded the fundamentals, who looked beneath the surface, survived. Graham learned, often the hard way, that detecting weakness before buying is as important as finding opportunity itself. Today, the stakes are no less significant. Markets are faster, global, and more complex than ever. Yet the principle remains unchanged. The key to long-term success is the ability to recognize weakness before committing your money. By studying a company's earnings, its debt, its assets, and the quality of its management, we gain insight into its true health, insight that can protect us from catastrophic loss. In this journey, we will explore the methods Graham used to identify weak companies, with examples from his lifetime and lessons that translate seamlessly into modern investing. From subtle financial red flags to warning signs in corporate behavior, we will uncover how discipline, analysis, and patience can reveal what the market often hides. But the challenge is subtle. Many weaknesses are disguised, and many investors are tempted by bright surface numbers, by clever marketing, or by a stock's rapid rise. To see the truth, we must adopt Graham's mindset: careful, skeptical, and relentlessly analytical. Only then can we separate the companies that deserve our capital from those that do not. To understand why Graham placed such importance on detecting weak companies, we must first step into the markets he navigated. The 1920s were an era of exuberance, often called the Roaring Twenties, where optimism seemed boundless and the stock market's rise appeared unstoppable. Ordinary citizens, teachers, clerks, factory workers were buying shares on margin, borrowing money to invest in companies they scarcely understood. Banks and brokers encouraged this behavior, fueling a speculative frenzy that seemed unstoppable. Amid this mania, many companies were lauded as investments simply because their stock prices were rising, not because of solid earnings or sustainable business models. Companies with shaky balance sheets, inconsistent profits, or high debt were treated as if they were untouchable. The market had become a theater of illusion, and few were willing or able to see the underlying weakness. Graham watched this world with a critical eye. He understood that markets are often driven by emotion rather than logic, by fear, greed, and the relentless pressure of the crowd. He had witnessed the rise of companies that looked strong, but whose foundations were fragile, and he understood that the first step in protecting one's capital was recognizing those vulnerabilities before buying. Then came the crash of 1929, a moment that would test every principle Graham had developed. Prices that had soared far beyond reason collapsed almost overnight. Companies that had been praised as invincible revealed serious flaws: too much debt, inconsistent earnings, poor management, and overextended operations. Investors who had ignored the fundamentals were devastated. Graham, who had studied and warned against speculative excess, saw firsthand the catastrophic consequences of buying without assessing strength.
The lessons of this era are timeless. Weak companies, whether overleveraged, poorly managed, or financially fragile, cannot survive a severe market downturn. Those that appear strong in rising markets can crumble when conditions change. And it is precisely in these moments that Graham's principles of margin of safety, intrinsic value, and disciplined analysis reveal their power. Even today, the environment may look different. Global markets, high-frequency trading, and instantaneous news cycles dominate the landscape, yet the underlying dynamics remain the same. Companies can appear strong due to hype or rapid growth, while hiding financial or operational weaknesses. Just as in Graham's time, investors who fail to detect these weaknesses risk losing far more than they anticipate. In Graham's view, the solution was not to chase the market, nor to rely on luck. It was to study, analyze, and remain patient. The market will swing, sentiment will shift, and prices will fluctuate. But a company's true strength or weakness is revealed through careful examination of its fundamentals. Benjamin Graham built his philosophy around a central idea. Investing is a matter of preserving capital first, seeking growth second. Detecting weak companies begins with this mindset. Graham taught that no matter how promising a stock might appear, if a company is fundamentally weak, the risk of permanent loss outweighs any potential gain. At the heart of his method is the concept of intrinsic value. Intrinsic value is the true worth of a company, derived from its earnings, assets, and future potential, rather than the fluctuating price the market assigns. Graham believed that the market often misprices companies, sometimes dramatically. A stock could be overvalued because of hype or investor euphoria, or undervalued because of temporary pessimism. To detect weakness, one must first understand what the company is actually worth. Closely linked to intrinsic value is the margin of safety, perhaps Graham's most famous principle. The margin of safety is the cushion between a stock's price and its true value. By buying well below intrinsic value, an investor protects against errors, unforeseen setbacks, or sudden market declines. For weak companies, the margin of safety often vanishes entirely. The stock may trade at or above intrinsic value, or the value itself may be fragile due to debt, declining earnings, or poor assets. Graham also emphasized fundamental analysis, a disciplined examination of a company's financial statements, balance sheet, and operations. He looked beyond superficial metrics like rapid growth or dazzling headlines to uncover the underlying health or weakness of a business. Earnings consistency, debt management, cash flow, and asset quality were all signals he scrutinized carefully. Weak companies, he observed, often reveal themselves through irregular earnings, high leverage, or assets that are overvalued or illiquid. Finally, Graham considered investor psychology a key factor. Even the strongest company can appear weak in the hands of panicked investors, just as a weak company can appear strong during speculative manias. Understanding the emotional context of the market allows an investor to interpret signals correctly and avoid being misled by temporary trends. These principles are not relics of the past. Today, they are equally essential. When evaluating a company, we must ask, does it have stable earnings? Can it cover its debts? Are its assets reliable? Is management competent and ethical? And critically, is the stock trading at a price that offers protection in case circumstances change? One of the first places Graham looked to detect weak companies was their earnings. A strong company, he believed, generates consistent and predictable profits. Weak companies, in contrast, often display erratic earnings, profits that surge one year only to plummet the next. In Graham's time, this was evident in many companies during the 1920s speculative boom. Investors chased stocks with flashy growth, ignoring irregular profits or declining revenues. When the crash came, these companies had no cushion to survive, and investors paid the price.
High debt levels were another red flag. Graham was clear. Companies over-leveraged with debt were highly vulnerable to economic downturns. Even a small drop in revenue could leave them unable to service their obligations, forcing cutbacks, asset sales, or bankruptcy. He analyzed interest coverage ratios, the ability of a company to pay interest from earnings, and warned that those failing this simple test were fundamentally weak. Consider an example from Graham's era. Some textile companies in the early 1930s appeared profitable because of temporary market trends, but a closer look revealed excessive borrowing to finance expansion combined with inconsistent earnings. When demand dropped during the Depression, these companies could not meet obligations, and stockholders suffered massive losses. Meanwhile, companies with steady profits and manageable debt endured the same market turbulence with far less harm. Modern parallels are striking. Today, a tech firm may post rapidly growing revenues but rely heavily on debt to fund expansion. A retail chain might report impressive profits one quarter but carry long-term obligations that far exceed cash flow. In both cases, Graham's approach would flag these companies as potentially weak, prompting caution before investing. The key lesson is simple but powerful. Earnings and debt tell the story of a company's financial resilience. Inconsistent profits, declining margins, or overextension through borrowing often precede failure. By studying these indicators carefully, an investor can detect weakness before buying rather than reacting after the market punishes it. Benjamin Graham often reminded investors that a company's balance sheet tells a story that earnings alone cannot. While profits show what a company has earned, its assets reveal what it actually owns and whether those assets can withstand the test of hard times. Weak companies frequently inflate the value of intangible or speculative assets, masking vulnerability until it's too late. Graham emphasized tangible assets, cash, inventory, machinery, real estate, resources that could be relied on even if markets turned against the company. Companies that appeared profitable but relied heavily on speculative assets, such as goodwill or overvalued stock holdings, were inherently weak. During the Great Depression, many firms that seemed solid on income statements collapsed because their tangible foundation was fragile. Liquidity was another critical indicator. Graham examined whether a company could meet short-term obligations without selling long-term assets at a loss. A firm may report profits yet face bankruptcy if it lacks cash or liquid assets to pay interest, wages, or suppliers. He often compared current assets to current liabilities, a simple measure of solvency that revealed hidden weakness. Historical examples illustrate the danger. Some manufacturing firms of the early 1930s carried significant inventory and receivables that could not easily be converted to cash. When demand fell, these companies could not meet obligations, forcing asset fire sales or bankruptcy. In contrast, companies with liquid assets and prudent financial management weathered the same downturns with far less harm. Modern parallels are easy to find. Today, a tech startup may show high revenue growth but have few tangible assets and negative cash flow. A real estate company might report profits while its holdings are over-leveraged or illiquid. By applying Graham's lens, valuing assets realistically, and assessing liquidity, investors can uncover weaknesses invisible in surface-level reports. In essence, assets and liquidity act as a safety net. Weak companies either lack that net entirely or have it built from unstable components. Detecting this before investing is critical. A firm with shaky assets or poor liquidity may survive short-term optimism, but a downturn exposes it and investors bear the consequences. Numbers can tell us much about a company, but Graham understood that the character and decisions of management often reveal more than the balance sheet ever could. Even a company with strong earnings, solid assets, and manageable debt can fail if its leaders are reckless, short-sighted, or dishonest.
In Graham's time, history offered many lessons. Some companies during the 1920s appeared financially sound, but their executives engaged in risky speculation, overexpansion, or deceptive accounting practices. When market conditions changed, these decisions proved disastrous. Shareholders, lured by impressive stock price gains or glowing reports, suffered the consequences. Graham saw firsthand that weak leadership magnifies a company's vulnerabilities. Graham encouraged investors to look for several red flags in management: frequent leadership changes, a pattern of overly aggressive acquisitions, a tendency to obscure financial statements, or a focus on short-term gains at the expense of long-term stability. Strong management, in contrast, acted prudently, communicated transparently, and built companies with resilience in mind. Consider an example. A manufacturing company with rising profits might still be weak if executives are borrowing excessively to fund expansion without regard for market conditions. Another might be technically solvent but hide declining margins or questionable accounting practices. The financial statements may look acceptable, but the company's decision-making culture exposes its fragility. Modern parallels are striking. Today, investors may encounter tech firms with charismatic leaders promising rapid growth but taking on unsustainable risks. Retail chains may be profitable, while senior management makes decisions that erode brand value or inflate costs. Evaluating management quality through track records, transparency, and prudence remains one of the most powerful tools for detecting weakness. Graham believed that good management acts as a stabilizing force during market turbulence, while poor management amplifies weakness. By examining leadership decisions alongside financial metrics, an investor gains a more complete picture of a company's true health. Benjamin Graham understood that the market is not always rational. Prices fluctuate not only because of company performance, but also because of emotion, speculation, and collective psychology. Even the strongest companies can appear weak when panic spreads, while weak companies can seem invincible during euphoric booms. Detecting weakness, therefore, requires reading both the company and the market. During the 1920s, speculation ran rampant. Ordinary investors, caught up in the frenzy, ignored fundamentals entirely. Stocks soared because everyone believed prices would continue rising, not because companies were sound. Conversely, when the 1929 crash began, fear gripped the market, dragging even fundamentally strong companies down. Graham observed that investor sentiment can magnify weakness or create the illusion of it. He developed a disciplined approach to separating market noise from company reality. A falling stock does not automatically signal a weak company, just as a soaring stock does not confirm strength. Instead, Graham urged investors to focus on intrinsic value, balance sheets, earnings consistency, and management quality, all metrics less influenced by hysteria. By comparing these fundamentals with market prices, investors could identify companies trading below their true worth and, crucially, avoid investing in weak companies disguised by hype. Modern markets offer similar lessons. During the dot-com bubble, investors poured money into internet companies with little revenue, valuing them on speculation alone. Many failed spectacularly once reality caught up. In more recent times, meme stocks or highly hyped IPOs have displayed similar patterns, weakness masked by collective optimism. Meanwhile, companies with steady earnings, sound management, and solid assets are often overlooked because they lack the flashiness that excites the crowd. Graham's key insight was that market sentiment can mislead, but careful analysis cannot. By examining a company independently of the crowd, we can detect true weaknesses before prices collapse or avoid being fooled by temporary euphoria. He treated the market as a pendulum, sometimes too pessimistic, sometimes too optimistic, and advised investors to stay rational, patient, and disciplined.
To truly understand how to detect weak companies, we must look at real examples, both from Graham's era and from modern markets. These cases reveal the warning signs he studied so closely and how they continue to apply today.
During the late 1920s, Graham observed textile companies that appeared profitable at first glance. Their income statement showed rising revenues, and their stock prices were climbing rapidly. Yet beneath the surface, these companies carried excessive debt, and their earnings were volatile, heavily dependent on seasonal demand and speculative expansion. When the Great Depression struck, their fragile foundations crumbled. Investors who had ignored the red flags, erratic earnings, high leverage, and speculative growth suffered devastating losses. Those who followed Graham's principles, analyzing fundamentals rather than hype, avoided the worst of the collapse. Another example comes from the banking sector of the same era. Some banks appeared solid due to large deposits and steady profits, but closer examination revealed risky lending practices and overextension into speculative ventures. Graham noted that these weaknesses often went unnoticed until a financial shock revealed their vulnerability. Banks with cautious lending policies, conservative management, and a strong balance sheet weathered the storm, proving that careful evaluation could distinguish strength from weakness. Fast forward to the modern era. Consider companies that experienced rapid growth in the early 2000s during the dot-com bubble. Many were profitable only on paper, relying on inflated stock prices and hype. Their underlying business models were unsustainable, and their financial statements often masked over-leverage or poor cash flow. When the market corrected, these weaknesses became painfully obvious. Investors who studied fundamentals, much like Graham advocated, recognized the risks early and avoided catastrophic losses. Even in recent years, companies with flashy products or aggressive marketing can appear strong while hiding structural weakness. Weakness may show in high debt ratios, declining cash reserves, inconsistent profits, or opaque management decisions. By applying the same lens Graham used, investors can spot warning signs before they are reflected in market prices. The lessons are clear. Weak companies rarely reveal their flaws openly. It requires careful examination of earnings consistency, debt, assets, liquidity, management, and market context. Those who ignore these signals may find themselves investing in a facade, while those who study them systematically gain a decisive advantage. One of the most fascinating aspects of Benjamin Graham's work is his counterintuitive approach. Detecting weak companies is not always straightforward, because what appears weak may sometimes be strong, and what appears strong may be weak. This paradox lies at the heart of his philosophy. For example, during the market turmoil of the Great Depression, some companies with temporarily declining earnings were actually financially sound. They had manageable debt, strong assets, and prudent management. Many investors, seeing falling stock prices and short-term losses, assumed these companies were weak and avoided them. Graham, however, recognized that these companies possessed hidden strength, and buying them at discounted prices offered a margin of safety and long-term opportunity. Conversely, companies that looked impressive on the surface, rapid growth, rising stock prices, or glowing press coverage, were often fundamentally weak. They might rely on speculative sales, overextended debt, or aggressive accounting to maintain appearances. Investors drawn to glamour and hype often overlooked the warning signs, only to experience sharp losses when reality caught up. Graham also emphasized patience and skepticism. Detecting weakness is not about reacting to every fluctuation or headline. It is about studying the underlying facts carefully over time. A company may appear stable for a quarter or two, but its financial patterns, management behavior, and debt obligations reveal its true resilience or fragility.
Another counterintuitive lesson is that weakness is not always obvious. It is often subtle. An unusual spike in expenses, a slight erosion of liquidity, or an aggressive acquisition strategy that strains resources. Graham's approach teaches us to look beyond immediate impressions and analyze every layer of a company's financial and operational reality.
Modern investors face the same challenge. During tech booms, meme stock surges, or hyped IPOs, companies can appear invincible while hiding structural weakness. Those who follow Graham's discipline framework, focusing on fundamentals, management quality, debt levels, and intrinsic value, can identify these hidden risks before committing capital. The overarching insight is this: intuition alone is unreliable. Analysis, patience, and discipline reveal the truth. Weakness often hides in plain sight, and strength may be disguised as weakness. Recognizing these subtleties separates successful investors from the rest. Benjamin Graham's lessons on detecting weak companies are as relevant today as they were nearly a century ago. Markets may have evolved, technology has transformed industries, and information travels at lightning speed, but the principles of sound investing remain constant. Weak companies, whether in the roaring 1920s or the modern digital era, exhibit similar patterns: inconsistent earnings, excessive debt, poor asset quality, questionable management, and vulnerability to market sentiment. The key takeaway is that protection of capital begins with careful observation and disciplined analysis. By examining a company's fundamentals, its financial statements, management quality, and market context, we can detect hidden weaknesses before committing our resources. Graham taught that investing is not merely about chasing growth or short-term gains. It is about understanding the true health of a business and ensuring that your investment decisions are grounded in reality, not speculation. Modern investors can apply these principles in practical ways. Before buying, ask: are the earnings stable and predictable? Does the company carry manageable debt? Are the assets tangible and reliable? Is management competent, ethical, and prudent? How does market sentiment affect the stock? And does it align with intrinsic value? When any of these answers raise doubt, caution is warranted. Weakness often hides in subtle signs, but careful scrutiny reveals it. Graham also reminds us to remain patient. Markets are volatile, and opportunities to buy strong companies at reasonable prices may not arise every day. Waiting for the right conditions, for stocks to reflect intrinsic value, is not inaction, it is disciplined strategy. Similarly, identifying weakness early allows investors to avoid the losses that destroy wealth, even when the market seems to favor risk-taking. Ultimately, detecting weak companies before buying is a combination of knowledge, observation, and discipline. It is about reading beyond surface appearances, understanding the forces that shape a company's resilience, and applying timeless principles consistently. Whether in the 1920s or today, Graham's methods provide a roadmap to protect your capital while navigating uncertainty. In closing, remember this: the market may tempt you with promises of rapid growth and easy profits. Many companies will look stronger than they truly are. But by following Graham's wisdom, studying fundamentals, analyzing management, assessing debt and assets, and maintaining a margin of safety, you equip yourself to see the truth. You learn to recognize weakness before it destroys value, and to invest with clarity, patience, and confidence. As Graham himself implied, success is not found in speculation, but in disciplined observation and rational analysis. In every era, this is the path to protecting your capital, identifying opportunity, and navigating the market with wisdom that endures. The careful investor does not chase the market. Instead, they observe, analyze, and act where weakness and opportunity intersect, always guided by the timeless lessons of Benjamin Graham.